Hello everyone, my name is Murtaza Zakai and I welcome you all to this insightful discussion on the conceptual framework for financial reporting. This is a very comprehensive topic and a very important one. I would suggest that you leave everything, yes, leave everything and just listen to what I have to say. Why? Because this conceptual framework sets the tone for understanding IAS and IFRS. Without it, learning IAS or IFRS is meaningless. Don't even attempt to learn IAS or IFRS without first understanding the conceptual framework. It's a waste of time. You might pass your exams by memorizing IAS and IFRS, but you will never feel or truly understand them if you don't study the conceptual framework. My friends, conceptual framework for financial reporting is like a Bible document for accountants. Let me explain this with an analogy. In every religion, there is a holy book that serves as the ultimate guide. Nothing deviates from this book. For example, in Islam, the Holy Quran is the divine guide. Now, across the world, you will find Muslims of many types. Some may refer to themselves by different region or practices like Arabs, Indians or others. But regardless of their differences, no one deviates from the Holy Quran. At least that's the idea. Yes, there may be difference in opinions and practices, but at the very least, everyone agrees on the Holy Quran as the central guiding document. Now, let's apply this analogy to financial reporting. Think of financial reporting as a religion. For us, accountants, it is everything, right? If financial reporting is the religion, then IAS and IFRS are its practices, like prayers or fasting in an Islam religion. And the conceptual framework is the holy book for accountants. It provides the ultimate guiding principles. Whatever IAS or IFRS are developed, whatever gaps company follow, or whatever financial reporting practices exist, the conceptual framework is the foundation. It is the ultimate reference point, at least in theory. Without the conceptual framework, you cannot develop a strong grip on IAS and IFRS. Let me explain you with another example. You cannot be a good Muslim simply by praying 5 times a day, even if you include Sunnah and Nafils, if you don't follow the teachings of the Holy Quran. Similarly, it does not matter how well you implement IAS or IFRS. If you don't have faith in and understanding of conceptual framework, you will never understand, you will never grasp the beliefs or principles underlying the financial reporting. The conceptual framework is the spirit, the soul of financial reporting. It gives you the motivation, the trust, and the beliefs needed to develop or implement IAS and IFRS effectively. My friends, one more important fact to note is that conceptual framework was revised in 2018. Well, in 1989, the framework for preparation and presentation of financial statement was issued. But then, International Accounting Standard Board, that is ISB, made amendments to it, and the new, although unfinished, framework was issued in September 2010 with a new name, the Conceptual Framework for Financial Reporting. And it stayed in progress for many years. And then in March 2018, the final version was issued with everything completed. This might surprise you, as in many religions, holy books and teachings are eternal. They don't change over time. Their teachings last forever. But The conceptual framework is not a divine document. It is not made by God. It is made by humans. And as human, we learn and evolve as we progress. So the conceptual framework was updated in March 2018 to reflect the changes and advancement in our understanding of financial reporting. So this new conceptual framework has 8 chapters, and each chapter deals with a specific aspect of financial reporting. Think of these chapters as building blocks. They help us understand the purpose, principles, and rules behind preparing the financial statements. So let's go through them one by one. The first chapter deals with the objective of general purpose financial reporting. That is, what's the whole point of preparing financial statement? Why do we even need them? The purpose is simple: to provide useful financial information about a business to people who need it to make decisions. These people could be investors, creditors, or even potential shareholders. For example, if an investor is deciding whether to buy shares of the company or not, the financial statement will help them figure out whether the company is profitable, how much debt it has, and whether it is a risky investment or not. In short, the objective of financial reporting is to provide relevant and reliable information that helps user to make informed decisions. Then, moving on to chapter 2, which is about the qualitative characteristics of useful financial information. This is super important, not just for understanding accounting, but also for your exams. What makes financial information useful? The framework says that it should have 2 main qualities: fundamental and enhancing characteristics, and we will explore them in greater detail in our future lectures. Next, chapter 3 talks about financial statement and the reporting entity. Basically, it defines what makes up financial statements and identifies what qualifies as a reporting entity, whether it is a single company, a group of companies, or even a subsidiary. Then let's move to chapter 4, which is about the elements of financial statement. The elements of financial statements are building blocks, the foundation of accounting, and there are 5 elements of financial statements: assets, liabilities, equity, income, and expenses. These are the ingredients of financial statement. Everything revolves around them. Then we move to chapter 5, which covers recognition and derecognition. Recognition means deciding when to include something in financial statement. For example, when to record revenue at the time of sale or when the payment is received. And derecognition is opposite. It's about deciding when to remove something from the financial statement. For example, if you sell a machine, you need to derecognize it from your assets. Next, chapter 6 deals with measurement. Often people confuse measurement with recognition, but this is different. Measurement is about how much to record, whereas recognition is when to record. For example, if you buy land, should you record it at cost price or at the market value? International accounting standards allows different measurement techniques like historical cost, fair value, net realizable value, and we will cover this more in later lectures. Now, let's talk about chapter 7, which is about presentation and disclosure. This chapter tells you how to present financial information and what details you must disclose in the notes to the financial statement. For example, if you are showing inventory, you must also disclose the accounting policies you use to measure it, like FIFO method or weighted average method. And finally, Chapter 8 is about capital and capital maintenance. This part is a bit technical, but the main idea is to define capital and explain how businesses ensure their capital is maintained over time. For example, if inflation reduces the value of assets, the business might need to revalue those assets to maintain capital stability. So to wrap it up, these 8 chapters covers everything from the objective of financial reporting to how we measure, present and maintain the financial information. And as we go deeper into each chapter, we will see how these concepts form the foundation for accounting standards across the world. Now, let's start our discussion with a simple question. What exactly is a conceptual framework? A conceptual framework is a statement of generally accepted theoretical principle which form the frame of reference for financial reporting. Think of it as a foundation, a set of theoretical principles that act as a guidebook for financial reporting. It's like having a rule book that helps accountants figure out how to handle financial transactions, measure them properly, and present them in a way that makes sense to everyone. The International Accounting Standard Board, that is IASB, developed this framework to ensure that all accounting standards follow a consistent approach instead of making random decisions or applying rules differently every time. So in the simple terms, the conceptual framework serves as a frame of reference for developing new accounting standards, evaluating and improving existing standards, and providing guidance when there is no specific accounting standard. Let's be clear about one thing. This framework may sound theoretical, but it has some very practical goals. Its main aim is to make sure financial information is useful for making business and economic decisions. After all, the primary purpose of financial reporting is to provide information to investors, creditors, and other stakeholders who need to make decisions about investing or lending money to the company. Now, why do we even need this framework? Imagine a world without clear accounting rules. Every company would make its own methods for recognizing income, measuring expenses, or valuing assets. There would be a chaos, no consistency, no reliability, and no way for investors to compare companies. For example, without the conceptual framework, one company could report revenue when it sends an invoice, while another might wait until it actually receives the payment. Investors would be left scratching their heads, wondering which numbers to trust. The conceptual framework solves this problem by providing a common language and consistent principle for preparing and presenting the financial statement. It helps answer the key questions like what event should we account for, when should we recognize revenue or expense, how should asset and liabilities be measured, how should we present financial information to make it clear and useful. Now, let's take a closer look at how the ISB uses this framework. Whenever the ISB needs to create a new standard, it does not just invent rules out of thin air. Instead, it looks at the conceptual framework for guidance. For example, suppose there is a new type of financial transaction that has not been covered by any existing standard. The ISB will refer to the conceptual framework to develop consistent principles that fit into the broader accounting system. Without this framework, a standard would be developed on ad hoc basis, meaning thereby decisions would be made randomly, and over time we would see inconsistencies and contradictions between standards. Think of it this way. The conceptual framework is like a blueprint that ensures that all pieces of accounting standards fit together like a puzzle. In summary, Conceptual Framework for Financial Reporting set out the core concepts for preparing and presenting financial statement. It gives accountant a reference point when making judgment about how to handle complex transactions. It ensures that financial statements provide useful and reliable information to the stakeholders. And most importantly, it helps the ISB develop new standards and evaluate existing ones, so we don't end up with confusing mixed rules and interpretation. So whether you are an accountant preparing financial reports or an investor analyzing a company's performance, the conceptual framework is what keeps the accounting world organized, consistent, and trustworthy. Also, remember a very important point. The conceptual framework is not a standard. Instead, it serves as a guidance tool for accounting standard. Think of it as the foundation or rule book that ensures accounting practices are consistent, logical, and useful across all standards. Now, let's break down the purpose of the conceptual framework into three key areas. First, it helps the ISB develop IFRS standards that are consistent and based on common principle. Imagine if every standard was written independently without any links to other. Over time, we would end up with contradictory rules, like one standard saying revenue should be recognized when cash is received, and another standard is saying that it should be recognized when goods are delivered. The conceptual framework prevents such inconsistencies by ensuring that all standards follow the same set of principles. Second, it helps preparer of financial statement develop accounting policies when there is no specific standard available for a transaction. Well, imagine you are an accountant preparing financial statement and you face a situation where no specific IFRS standard applies to the transaction you are dealing with. For example, cryptocurrency is a modern financial phenomenon, but there is no specific IFRS standard covering it yet. In such cases, you cannot just guess what to do or create your own rules. Instead, you need a reference point, a set of principles that can guide you in making the right accounting decision. You go to the conceptual framework to assess its features. Is it an asset? Is it inventory? Or maybe a financial instrument? And based on these characteristics, you will determine the closest applicable standard and the accounting treatment that aligns with the framework principles. Third, it helps all users of the IFRS standard, including auditors, regulators, and investors, to understand and interpret the standard in a consistent way. Think about it. Financial statements are prepared by accountants, but used by decision makers like investors, lenders, and analysts. The conceptual framework ensures that the language of accounting is uniform so that everyone, whether they are reading the IFRS 15 on revenue or IFRS 16 on leases, can understand the logic behind these rules. Now, it is important to note that conceptual framework is not something accountants rely on every single day. Most of the time, a specific standard already exists to guide accounting decisions. But in rare cases, whenever there is an ambiguity or a new type of transaction emerges, this framework becomes absolutely critical for making judgment-based decisions. So to sum it all up, the conceptual framework plays a crucial role, ensuring that IFRS standards are consistent and follow common principles. guiding accountants when there is no specific standard available for a transaction, and helping users of the financial information, whether preparer, auditor, or investor, to understand and interpret the standard in a clear and logical way. And this brings us to the bigger picture. The conceptual framework don't just make accounting easier, it makes it more reliable, transparent, and decision friendly for everyone involved. Alright, my friends, that's bring us to the end of today's lecture on the conceptual framework. I hope you now have a clear understanding of why this framework exists and how it plays such a crucial role in financial reporting. Think of the conceptual framework as a backbone of accounting standard, a guiding light that ensures everything in financial reporting is consistent, logical, and decision useful. Whether it's helping the ISB draft new standard, guiding accountants when there is no specific standard available, or ensuring that investors, auditors, and regulators interpret standards the same way, it's all about clarity and reliability. Remember, financial reporting is not just about numbers, it's about trust. Trust that the information is accurate, transparent, and comparable across industries and regions. And that's exactly what the conceptual framework is here to protect. So the next time you face a judgment-based decision in accounting or come across a new type of transaction, don't panic. Just go to the conceptual framework. It is your anchor in the vast ocean of IFRS standard. Thank you so much for joining me today, and I will see you in the next lecture, where we will dive deeper into the chapters of conceptual framework and start exploring its building blocks. Until then, keep learning and keep growing. Take care and thank you.